If a fund says it seeks twice an index's daily return, what does the word daily change? It changes the promise, the reset, and the question a holder must ask before treating a familiar ticker like a long-term multiplier. Leveraged ETFs are exchange-traded funds built to pursue a stated multiple or inverse result for a stated period, commonly 1 day. That period is not fine print. It's the center of the product objective, so this episode treats the label as a contract to read, rather than a trade to copy.
The practical trap is a screen that shows a multiple beside an index. A viewer may translate that into, the index rose 10% this month, so this fund should rise 20. That calculation skips the reset between every trading day.
That shortcut sounds tidy because it tells one clean story. Markets are less cooperative. The starting point changes after the first day, then the second day's percentage works on that new amount, not on the amount you remember buying.
The Securities and Exchange Commission cautions that leveraged ETFs generally seek their objectives for a single day, not for longer periods. Michael, that source doesn't say no one may own one. It says the time unit in the objective must govern the interpretation.
Exactly. I would treat the objective like a torque specification in a manual. The number is useless without the condition attached to it. 2 times is incomplete. 2 times for a daily objective is the sentence you need to evaluate.
A recurring viewer question is whether the product is simply a faster version of a broad market fund. It's not a speed setting. The stated target, the reset process, the derivative exposure, and the holding period change the story.
Funds can use tools such as swaps, futures, options, short positions, or other derivatives to pursue leveraged exposure. What mechanism does the current disclosure name? Those mechanics are not a verdict on any particular fund. They are a reason to read its current documents instead of assuming the ticker explains the whole design.
Michael, the phrase daily target can sound almost too technical to carry emotion. Yet it changes a real person's expectation. Someone sees an index recover by the end of a week and assumes the story ends there. The daily objective says the fund lived every turn in between. That difference is not a footnote, it's the plot.
And the calculation is not hidden because it's advanced. It's hidden because people compress time when they talk. They say this week or this quarter. The product statement may say daily. When those time labels don't match, stop the conversation there and return to the current document.
Isabella, that's a useful reading habit for every investment claim. Underline the action word, the measurement, and the period. A fund can state an objective clearly while the reader supplies an unstated horizon. Our job is to keep the stated horizon visible before we make any inference from past performance or a chart.
Wait, does daily reset mean the fund sells everything at the closing bell?
Not necessarily. Daily reset describes bringing exposure back toward the stated daily target. The specific method belongs in the fund's disclosures. That distinction matters because a useful question for a broker or fund sponsor is how is exposure maintained and what instruments may be used.
That's the unglamorous part of the story, which is why it gets skipped. The impressive number becomes the headline, while the actual operating instructions sit in a document waiting to be read.
Myth. A 2 times daily objective means a 2 times result over every period. Fact. Over periods longer than 1 day, outcomes can differ significantly from that daily multiple. Next, we will use 2 paths with the same endpoints and different results.
One more practical boundary: past returns, whether shown for 1 day or 1 year, are records of what happened, not a personal instruction. The daily objective tells you the product design. It doesn't tell you how much risk a particular household can carry. Before any action, separate the product fact from the personal decision.
There is a quieter benefit to saying the full phrase. It stops a viewer from feeling foolish for needing a pause. The product is not made simple because its ticker is short. A clear explanation may take a few more words, and those words can prevent a casual assumption from becoming an expensive Insedanstang.
Real quick, because this next part matters to you. If any of this is helping, tap that like button, then hit subscribe and ring the bell so the next one finds you. Both are free and take about a second, but they tell the algorithm to show this to one more person who needs it.
The word reset is doing more work than it first appears to. Imagine starting a road trip each morning from wherever you actually stopped, not from the original driveway. The next day's percentage begins from the current account value.
That changed base is the whole calculation. If a fund starts at $100, a daily gain or loss changes the amount exposed tomorrow. The reset doesn't erase yesterday. It changes the starting line for the next daily objective.
Professor Iwata, give us the disciplined version. What should a viewer refuse to assume when a daily reset product appears in a portfolio screen?
Refuse to assume that a daily target is a prediction, a guarantee, or a multi-day formula. It's an objective stated for a period. FINRA makes the same point. Examine the stated holding period, risks, and costs before treating a geared product as a generic exchange-traded fund.
So the first question is not, did it have a big day? It's, what exactly does it say it seeks, for which period, and through what design? That moves the viewer from a headline to a record.
And then make the record operational. Open the summary prospectus. Find objective principal risks, fees and expenses, benchmark, and holdings or derivatives disclosure. Don't hunt for a magic signal. Build a list of facts you can verify.
The wording matters. A daily objective can be positive or inverse, and the target may be described before fees and expenses. That's not a small qualifier. It means the product's disclosed expenses and the path of returns can matter before a viewer reaches any personal conclusion.
There is also no universal number that tells every person whether a product fits. Time horizon, cash needs, other exposures, tax position, and the actual product documents are personal facts. A licensed professional can help connect those facts. The disclosure can't do that interview for you.
Professor Iwata, this is where the ordinary investor story usually forks. One person says, I understand it moves more. Another says, I understand what it's designed to do during one day, what can make a longer path differ, and which document tells me the current terms. Those are not the same level of understanding.
Precisely. Familiarity with the words exchange-traded fund, index, or leverage doesn't substitute for reading a specific objective. Product categories contain variation. A disciplined review keeps the issuer's own current language, the benchmark description, and the principal risk section together instead of borrowing a rule from a different product.
If I were organizing this on a desk, I would make 4 columns. What the objective says, what the benchmark is, what creates exposure, and what costs or risks are disclosed. If a sentence from a video doesn't fit one of those columns, it may be commentary rather than a fact you can act on. I almost called the reset a daily rebalance, but that can sound like one identical mechanical action across every fund. Better wording. The fund seeks to reset exposure toward its stated objective. Read the actual method instead of borrowing my shortcut.
Which fact still needs a current source? Okay, that was good. A document has just defeated a neat sentence, which is rude but useful.
Keep that correction. It's a skill, not a failure, to replace a convenient label with the precise one. Now we can show why 2 days with the same index endpoint can still tell different leveraged fund stories. A careful reader also notices what is absent from a short description. It may not state every operational detail, every cost, or the full set of risks. That's why the summary prospectus is a starting point rather than a substitute for current documents. Precision begins by knowing when a summary has reached its limit.
Let us use a labeled hypothetical, not a forecast. Start an index at 100. On day 1, it falls 10% to 90. On day 2, it rises about 11.1%, bringing the index back to 100. Same endpoint, uneventful-looking summary.
But the 2 days were not uneventful to someone living through them. The first day changes the base. The second day is a recovery from 90, not an 11.1% gain on 100.
Now suppose a hypothetical fund seeks twice the index's daily return before fees and expenses. On day 1, a 10% index decline corresponds to a 20% daily decline in the illustration. 100 becomes 80. That's only the first reset.
Day 2 applies the daily relationship to 80. A roughly 22.2% illustration gain takes 80 to about 97.8. The index ended where it started in this simplified path. The hypothetical leveraged fund did not.
That's path dependence in plain language. The route matters, not only the map's beginning and end. Two people can point at the same index level and still have experienced very different sequences underneath it.
The numbers are deliberately simple. They don't model fees, spreads, taxes, financing costs, tracking differences, or any particular fund. They show the arithmetic reason the Securities and Exchange Commission says longer period returns can differ significantly from a stated daily multiple.
A common response is, then I will wait for a smooth market. But smooth is only visible in the rear-view mirror. The useful work is to understand what the product says it targets and how changing bases affect a multi-day result.
And volatility is not a villain in a story, it's movement. In this context, larger back-and-forth moves can make the gap between a daily target and a longer period expectation more noticeable.
Notice what this example doesn't prove. It doesn't identify the future return of an index, a fund, or a portfolio. It doesn't calculate a real fund's tracking result. It demonstrates a general arithmetic point. Percentages multiply from the value that exists after the prior change. That's why sequence deserves attention.
Here is another way to audit your own explanation. Say the path out loud in order. Start, first daily move, new value. Second daily move, final value. If you jump directly from start to final index level, you have removed the exact information a daily reset objective needs in order to be interpreted honestly.
The human temptation is to remember the recovery because it makes a better ending. But a percentage recovery starts from the lower number. The missing distance is not drama, it's arithmetic. Once you see that, a volatile line on a chart stops being merely exciting and becomes a sequence of changing bases.
Right. The word drag is sometimes used as shorthand, but don't let shorthand become an explanation. The mechanism is compounding from changed values. Losses require larger percentage gains to recover, and a daily multiple compounds from each new base.
If something falls 20%, it needs 25% to return to the starting value. That's not a leveraged ETF rule, it's percentage math. Leveraged daily exposure can make that changed base math more consequential.
The tidy ending would be an instruction. We're not giving one. The stronger ending is a question. Can you explain the daily objective, the reset, and a 2-day path without turning any of them into a promise?
Did the calculation preserve each day's changed starting value? If not, pause before acting and read the documents or ask a broker to explain the product mechanics. The next scene is about the questions that turn that pause into a useful review.
Run a second illustrative path in your own notes if it helps. A rise followed by a decline. The point is not to predict a number or find a winning sequence. It's to watch each percentage apply to the value that exists at that moment. That small act makes the phrase daily reset concrete without pretending to forecast a fund.
The same discipline applies when comparing one chart with another. Check the dates, the benchmark, the period, whether the result is total return or price return, and whether the product objective is daily. A comparison that leaves out the time unit can look exact while answering a different question from the one you meant to ask. A prospectus is not decoration around a ticker. It's where the fund describes its objective, principal risks, fees, and expenses. A viewer doesn't need to become a derivative specialist to use it. They need to stop outsourcing the words that govern the product.
Start by reading the objective word for word. Note the benchmark, the stated period, whether the target is before fees and expenses, and any language about daily resetting. Then read principal risks for leverage, derivatives, volatility, compounding, and trading-related risks.
Then ask a broker questions with a definite answer. What account permissions are required? What happens if I place a market order in a fast market? Which costs are fund expenses, and which are brokerage or trading costs? Where are the current documents?
That conversation is more revealing than asking a broker which product to buy. One asks for mechanics and records. The other tries to hand over a decision that belongs to facts the broker may not know about your household.
Personal tax consequences have a different owner. A qualified tax professional can discuss a person's realized gains and losses, account type, records, and current tax rules. A broker can explain a statement or trade confirmation. Neither question is answered by a chart alone.
Costs deserve the same separation. Expense ratio is a disclosed fund expense. Bid-ask spread, commissions where applicable, and taxes can be distinct. Don't add them casually into one invented number. Find each item in its actual record and ask what it means.
I like that because it prevents the all-purpose expert fantasy. My hardware manual can tell me a torque setting. It can't tell me whether I should rebuild a motorcycle in my garage. Different question, different owner.
And it makes a pause feel active. Someone reading a disclosure is not failing to act. They are choosing not to let a familiar word, a large percentage, or a confident clip make the decision before the facts arrive.
A current prospectus will not make a personal decision for anyone, and it should not be asked to. It can establish what the fund says it seeks, how it describes principal risks, and which expenses it reports. That's enough to improve the next conversation with a broker, advisor, or tax professional.
The record-keeping question is concrete too. Save the current document version you read, note the date, and keep trade confirmations or statements if you make transactions. A qualified tax professional can't reconstruct a personal tax question from a memory of a headline. Records make the later question answerable.
There is relief in that boundary. You don't need a hot take from every source. You need a clean source for each kind of question. The fund document describes the product. The broker explains the account. A qualified professional discusses the facts that are personal. That division is calmer than a slogan.
Here is a compact review list: objective and daily period, benchmark, principal risks, fees and expenses, trading and account mechanics, and the professional question that remains personal. Each item has a record or a person who can answer it more honestly than a slogan.
One small correction, Erica. I called that the final list. It's a starting list because current documents can change and each product is different.
Corrected. Starting list. The record gets the last word, not our memory of it.
When a disclosure uses a word you don't understand, write the word down before searching it. Search the issuer's documents and regulator education first, then ask a broker or qualified professional about the remaining personal question. That order reduces the chance that a confident promotional explanation becomes the source you trust most.
It's tempting to turn this checklist into a test with one correct outcome. It's not. It's a way to make a decision conversation more specific. A person may conclude they need more information, that a risk is not acceptable, or that they should discuss their facts with a professional. Each is a legitimate result of better reading. We began with one word, daily. It turned out to be a doorway into exposure, changed bases, volatility, costs, documents, and the discipline of asking who can actually answer a question. That's more useful than memorizing a dramatic ticker move.
My practical version is shorter. Name the time period, then don't delete it from the sentence in your head.
Good. A leveraged ETF's stated objective is a daily objective, not a blank check for a longer period expectation. A 2-day path can produce a different result from the headline multiple because each day begins from a changed value.
And the record is not an obstacle course set by some paperwork-loving committee. It's the map of what the product says it's trying to do. Michael has built easier instructions for a crib, but he agrees with this one.
I do. It needs fewer mystery screws. Read objective, risks, fees, and mechanics before you let a familiar exchange-traded fund label make the product feel simple.
For a broker, ask about the account, current documents, order mechanics, and where each cost appears. For a qualified tax professional, ask about your records and tax situation. For a licensed financial professional, ask how the product relates to your time horizon, risk capacity, and other holdings.
No one here is telling you to buy, sell, or hold a specific fund. We're giving you a way to make the next sentence you read more precise than the last one.
That's winnable. Open the document before opening a position.
Before an online claim changes an investing decision, ask 4 questions in sequence. What is the stated objective? What time period is attached to it? What changed base arithmetic would occur over more than one day? Where are the current risks, fees, and mechanics recorded? Each question narrows a vague impression into something verifiable.
That sequence also keeps a viewer from treating access as understanding. A brokerage app can make a product available in seconds. Understanding still takes reading, comparison, and sometimes a conversation with someone qualified to discuss your particular situation. Convenience is a feature of the interface, not evidence of fit.
And a good question survives the next market headline. What does this product seek each day, and what record tells me that? Remains useful whether the market rises, falls, or does both before lunch. That's a sturdier skill than trying to turn every dramatic move into a personal instruction.
A final check is whether the action you are considering requires a personal answer that this video can't supply. We can explain a daily objective and a 2-day illustration. We can't know your cash needs, other investments, tax facts, or risk capacity. Those facts are where a broker, advisor, bank, or qualified tax professional may have a narrower and more useful role.
Use that pause to write the exact question you still can't answer from the document. A good question might be about account permissions, the order process, a statement label, or the tax record you need to keep. Specific questions produce specific answers. Vague confidence doesn't. That's the guardrail I would keep beside the login screen. Product access doesn't answer whether you can tolerate a rapid change, need the money soon, understand the costs, or have other exposure pointing the same direction. If those questions are not answered, the next useful action may simply be to collect better information.
Right. A pause can be a decision with more care in it than a rushed click.
If this helped you separate a daily objective from a long-term assumption, like the video and subscribe for the next Investing Explained lesson. The last question: which exact time period does the investment claim you are considering actually promise to target? Read the time unit, then read the record. Take care.